Did you know that private mortgage investors are currently earning 8 to 12% returns while traditional bank accounts pay less than 2%? This overlooked investment strategy is funding borrowers who banks reject, yet has a default rate of just 1.15% according to BNN Bloomberg. By the end of this video, you'll understand exactly how to tap into this market, the minimum investment needed, which is surprisingly accessible, and how to avoid the common mistakes first-time mortgage investors make. I personally helped some of my family members increase their income. This legitimate investment strategy has been quietly building wealth for decades, and today I'll show you how. Let me start with a question. Are you happy with the returns from your savings account? The large banks are paying less than 2% while inflation eats away at your money. This is the reality for most young investors today. Traditional investments like savings accounts, GIC, and government bonds are falling behind inflation. When banks advertise high interest rates of 2 to 3% while inflation runs higher, your money actually loses purchasing power while sitting at the bank. Consider Sarah, a software developer who diligently saved $40,000 over 3 years for a down payment. During that time, her high-yield account earned 2.1% annually, while housing prices in her area increased by 7% each year. Despite her discipline, she still ends up further from home ownership than when she started, like trying to fill a bucket with a hole in the bottom. The problem intensifies in the housing market. Property prices continue to climb in most Canadian cities, with the Canadian Real Estate Association predicting a 6.6% increase in home sales in 2025 alone. These rising prices make it difficult for young investors to build wealth through traditional real estate, as down payments grow larger and cash flow calculations rarely work in their favor. Many of us work harder than ever, but watch our money stagnate. Savings is too slow. We need better investment vehicles. The traditional system doesn't help an average person build wealth. Meanwhile, banks prosper from this arrangement. Take our deposits paying minimal interest, then lend that same money out at 5 to 7% for mortgages. Their quarterly reports show billions in earnings while paying us almost nothing for using our money. Investment opportunities broadly fall into 3 categories: real estate, paper assets, and businesses. Take Mark, who invested $25,000 in a diversified stock portfolio, only to watch it drop 20% during a market correction, creating more stress than growth. Others investigate rental properties, but can't make the numbers work with today's prices. Starting a business requires significant time and capital with high failure risks. This creates a catch-22. We need our money to grow faster to reach financial goals, but traditional options aren't delivering. The situation is particularly challenging for self-employed individuals. Despite earning good incomes, they often find themselves excluded from traditional lending channels because banks typically require consistent pay stubs and T4s. If banks are doing well, why not become the bank as well? This explains why private mortgages are gaining popularity. They offer returns of 8 to 12%, 4 to 5 times higher than most bank savings accounts. For investors frustrated with minimal returns, this presents a compelling alternative where your money works significantly harder without excessive risk. I first learned about private mortgages from a mortgage broker who connected lenders to borrowers. My first making experience was very scary, but ultimately successful, with my initial investment returning only 12 months later. Now, let's see how these investments work and why they might be a solution many have been seeking. You might wonder what exactly a private mortgage is and how it offers such high returns without excessive risk. Simply put, a private mortgage is a loan given to borrowers who don't qualify for traditional bank financing. These borrowers aren't random people with bad credit. They're often self-employed individuals, contract workers, or property developers who have solid assets but don't fit into the strict lending criteria banks use. Think of a private mortgage as a neighborhood bank that sees potential where big institutions only see risk. Take Mike, a contractor earning over $140,000 annually. Despite his strong income, he couldn't get approved for a mortgage for any major bank. His income fluctuates monthly, and he writes off business expenses that reduces his taxable income. The bank's computer system rejected him automatically. The private mortgage lender examined his overall financial picture, checked his assets, and approved him in about a week. Private mortgages typically operate through mortgage investment corporations or MICs. These companies function like financial reserves. They collect funds from multiple investors like us, pool these resources together, and distribute them as mortgages to qualified borrowers. When you invest in a MIC, you become part of this lending community. The minimum investment typically ranges from $10,000 to $50,000, with an average of $100,000, making it accessible to many investors. The approval process for borrowers is thorough. MICs evaluate creditworthiness, verify income through multiple sources, and conduct property appraisals. This careful assessment helps protect investor funds and keeps default rates low. Next, let's take a look at how the system safeguards your investment. Once a mortgage is approved, the MIC funds the loan using the pooled investor money. The borrower makes monthly payments, including principal and interest, typically interest only. These payments are distributed back to investors as returns, usually paid monthly or quarterly, creating a steady income stream. Unlike owning real estate, there are no landlord responsibilities. You receive payments based on your investment share without dealing with tenant issues or property management. The security comes from these mortgages being secured by real property. If a borrower defaults, the MIC can take possession of the property and sell it to recover the investment. Most private mortgages have a lower loan-to-value ratio than bank mortgages, typically not exceeding 75% of a property's value, compared to the bank's sometimes 95%, creating a protective buffer. Private mortgages have existed for decades, but were mainly accessible to wealthy investors. MICs have democratized access, allowing regular investors to participate in this growing industry that serves non-traditional employment needs. MICs operate under specific regulations with professional management handling everything from borrower assessment to portfolio management, providing expertise most individual investors couldn't achieve alone. Now that we understand how private mortgages work as an investment vehicle, let's examine the specific benefits that make them worth considering for your portfolio. The returns from private mortgages might seem unusually high at first glance, but when you look closer, there are clearer reasons why these investments perform better than traditional options. I want to show you exactly why they're worth your attention. Let's take a look at some real numbers. In 2024, a typical mortgage fund increased its target yield range to 8 to 12%. Compare that to the best 5-year GIC rate you can find today, which hovers around 4%. This difference dramatically changes how quickly you can reach financial goals. Here's the power of these returns. $10,000 invested at 2% annually grows about $12,000 over 10 years. That same amount at 10% compounds to nearly $26,000. Extend to 30 years and you're looking at around $18,000 versus nearly $175,000. Alternatively, you could receive monthly income. At 10%, a $100,000 investment generates about $833 monthly. Imagine you can transform retirement plans such as funding your grandchildren's education using just the monthly payments from your mortgage investments, or take a dream vacation. Private mortgages add true diversification to your portfolio. While many investors believe a mix of stocks and bonds provides adequate protection, these traditional investments often move in tandem when interest rates fluctuate. Private mortgages operate differently. Their returns come from interest payments on real estate loans, creating stability independent of market movements. The consistent monthly cash flow is a major advantage. Unlike stocks where value might increase but dividends remain small, private mortgages generate predictable income you can count on. This consistency simplifies financial planning significantly. You can forecast your investment income with reasonable accuracy rather than just guessing about market performance. For investors concerned about Canada's housing market, Private mortgages includes built-in protection through low loan-to-value ratios. While banks might lend up to 95% of property value, private lenders typically cap at 75% or lower. This creates a substantial safety buffer during market corrections. This conservative approach has proven effective even in Canada's most volatile housing market. According to Nicola Wealth Research, Vancouver's average selling price haven't dropped below maximum lending value at any point from 1990 to 2022, despite experiencing several significant market corrections during this period. Additional protection comes from Canada's historically low mortgage default rates compared to other G7 countries, with repayment strategies embedded directly into mortgage terms. Private mortgage delivers higher returns, meaningful diversification, and reliable monthly income, creating a powerful investment option increasingly popular among Canadians. I want to completely be transparent though. Higher returns always involve some level of risk. Seek legal and financial advice before making any investment decision. Now, we've covered a lot today, and it's clear that private mortgages offer a practical solution to the low returns most young investors face today. With 8 to 12% returns instead of the 2% from banks, your path to financial freedom speeds up significantly. To get started, speak to your lawyer or mortgage broker about this opportunity. You can begin with as little as $10,000. For those interested in our mortgage investment corporation, check the link in the description to join my VIP list so you know when we'll be launching. After investing, you'll receive monthly income payments directly to your account, consistent returns without landlord headaches or market timing worries. Thanks for watching.